In a very big move, the Fed came out with a bazooka last night, and here to give us some context on what this means and how things could evolve as we move forward, I'm here with Scott Coburn. He's Managing Director of Global Fixed Income. I want to start with the timing because the Fed was planning to come out this week. They didn't wait. So tell me a bit about why you think they had to move right now.
We're seeing a dramatic weakening in the global economic activity. I mean, countries and states are shutting down and restricting activity and social distancing. And so in response to that, the slowdown in economic activity, the Fed moved up its meeting from the two-day meeting earlier scheduled this week to Sunday evening with an extraordinary move, restarting quantitative easing. They cut rates down to effectively zero, the 0 to 25 basis point range. And then they've enhanced liquidity as well for the functioning, the effective functioning of the capital markets. So it's an extraordinary move.
And it's coordinated as well. We actually saw that a number of other central banks coming in and everyone trying to work together around this.
Yeah, so we had the Reserve Bank of New Zealand last night cut rates down to 25 basis points. Australia indicated that they're going to be moving this Thursday as well. You had the Bank of Canada on Friday move, and they'll likely join the Fed at 25 basis points sometime this week. So you're definitely getting a coordinated reaction by the central banks. You've got the rate cuts, you've got restarting of asset purchases, and this, dealing with the plumbing issue, which is essentially making sure that the markets function, introducing, repos, what they call term repos. And then there's a variety of customized measures, depending on your country. So they're coming out in full force. And then now, though, it has to be joined by fiscal policy and response on the healthcare system as well.
One thing, what are you seeing in the markets right now? Because I think the one thing that, the market reaction this morning has not been positive. Right. There's a bit of, this was a big move, but at the same time it spooked, I think, the markets a bit in terms of what equity investors were looking. So what is the Fed trying to get ahead of?
I mean, the Fed wants the markets to function as efficiently as possible given the tremendous uncertainty. We're going through a dramatic economic slowdown and there is a shock. And this response is not going to solve that. It's not solving the virus challenge, but they want to make sure that the markets are liquid. And that's what they're really trying to address at this moment with the aggressive actions. We expect the G7 to have an emergency fiscal meeting, probably extended to G20. So this is going to complement other actions to try to stabilize things, but it's clearly it's a public health emergency that monetary policy alone can't resolve.
Let me ask you, you're right, public health emergency, and this is the first of hopefully other big packages, fiscal stimulus coming in. Is there more the Fed or the central banks could do at this point?
Absolutely.
There is.
There is. Well, I mean, the creativity. You're only limited by your imagination and creativity. Certainly, there are programs that were, in 2008 that deal with commercial paper in the U.S. The Bank of Canada introduced a banker's acceptance purchase program that will get more details this weekend. So we can, they'll develop programs as they see challenges in the markets, and it's a very fluid situation. They don't pretend to have all the solutions right out of the gate. So, creative solutions will come along. They certainly can increase QE. They can extend the length of forward guidance. Effectively, New Zealand said rates are going to stay here for a year. So you can do a lot more, but this is the initial salvo.
Let me ask you, if you're an investor and you're watching the markets, over the past week and even today, what should people keep in mind? This is a tough time.
Yeah, I think you think of it two ways. One, in the short term, there's going to be tremendous volatility, a shock. It's going to be difficult. Hopefully, you've got a well-diversified and liquid portfolio. But certainly, longer term, over the medium term, this is setting up, investors for taking advantage of attractive companies and corporate debt.
I feel like I should ask you one last thing before I let you go. Negative rates. That's the one thing people are talking about. And again, I know you're not a fortune teller, but does this set us up in that direction?
Well, both the Bank of Canada and the Fed indicated that their preference is not to go there. And so, I think other initiatives will be used before we even get to that situation, which, is well entrenched in Europe.
Scott, thanks very much.
My pleasure.